All right. Hello, everyone. Welcome to another presentation in the Self-Directed 101 that we do live every Tuesday at our office in Ambler, Pennsylvania. We welcome you to bring along with you any friends, family, professionals that you might think would benefit from this information. And we're going to go over the basics of self-direction today. Before we get started, just a brief disclosure to let you know that everything in this presentation is strictly for educational purposes. It's not to be intended to be taken as advice. We recommend you always do your own due diligence. We're not tax professionals, attorneys, or accountants here at Camoplan. So that's why I recommend, like I said earlier, to bring in your professionals of any sort to, try to poke holes in this, see the information, that have them get comfortable with the information as well, so that we can all work together in being able to facilitate the transactions in a quick and efficient manner. So to get started, some things we'll go over today is what is self-direction, what does it mean, what types of accounts can be self-directed, what types of investments can be made, some investments that cannot be made, how the process looks at a high level, and then we'll briefly touch on some tax considerations to bring over to your accountant towards the end. Again, we're not tax professionals, but we'll just touch on some things that you might want to talk to your tax professional about. So, what is self-direction? You might go to one of the brokers like Fidelity or Schwab, and they may tell you you have a self-directed account with us. But in reality, what they mean is you can direct your investments into anything off of this list. With a truly self-directed IRA like the ones offered at Camoplan, there is no list. You find the investment that is right for you, and we'll help facilitate the transaction into that investment. Self-direction is just an adjective, which pretty much is just a marketing term saying that the custodian you're working with is able to facilitate the transactions into those investments. But that's why some people use it and tell you can self-direct it into a list of investments they already offer. But again, truly self-directed IRA, there is no list like the ones that we provide at Camoplan. This is a quote from one of our clients: investing in what you know, understand, and can control versus using hope as your strategy. A lot of people think that you have to have your money tied to the casino of Wall Street, your retirement plan in specific. That's not true. That's not the case. You can use your previous knowledge with the alternative investments you may be making with your discretionary funds and your personal investment life, with your retirement plan as well. You can even partner with your retirement plan for these investments. Um, like I said, self-directed is just an adjective. All of these accounts can be self-directed. There's no self-directed IRA. When you open up an account with us and you go to the application, the first question is what type of account you want to open with us. And if you click the drop down, there is no self-directed IRA. Again, it's just a marketing term. It's just an adjective to let you know that you can invest into these alternative investments with us. In reality, the accounts that are actually opened are actually self-directed through us, fall into two buckets. So you have the tax deferred bucket and the tax free bucket. What I mean by that is with the tax deferred accounts, you don't pay taxes on any of the contributions that you make into the account. However, years down the line, those contributions and whatever they grew into via the earnings and the investments that you made through the tax deferred account, when you take it out of the account at the time, you're going to be taxed at that current amount in your current tax bracket. On the other hand, with the tax-free bucket, those accounts, you pay your taxes on the contribution, and whatever they grow into years down the line, when you take it out for a qualified distribution at 59 and a half or older, everything you take out of that account is tax-free because you already paid your taxes on the front end. So the way we like to phrase it is, would you rather pay the taxes on the seed or the harvest? With the traditional or tax deferred IRAs, you're more so paying on the harvest, where on the other hand, you're paying on the seed. Looking into the buckets a little bit deeper, in the tax deferred bucket, you have a number of accounts that fall into that bucket. You have the traditional IRA, which is an individual IRA. It was the original IRA offered. That's why it's now called traditional IRA. It used to just be IRA. Spousal IRA is misleading. Spousal IRA means you have a working spouse and a non-working spouse, and the working spouse can contribute on behalf of the non-working spouse. The spousal IRA is another one of those adjectives. It can be a traditional. It could also be a Roth, that spousal IRA. Then you have underneath it, you have some employer-linked IRAs like the SEP IRA and the Simple IRA. SEP IRA stands for Savings or Simplified Employee Pension IRA, and then you have the Simple, which stands for Savings Incentives Match Plan for employers. And then below that, you have your defined benefit plans and your defined contribution plans. These are your employer plans. that are your 401ks, your 403bs, your 457s, your TSPs or thrift savings plans, all of those accounts on the tax deferred side. Then on the other hand, in the Roth IRA or in the tax-free accounts, you have the Roth IRA. You have the health savings account, which is the only account of its type where the contributions are tax deferred, and the distributions can even be tax free as well if for a qualified medical expense. Below that, you have the educational savings account or Coverdell, and then those 401ks we mentioned on the tax deferred side can also have Roth portions to them as well, depending on how they were set up. If you were to take anything out of this slide, just know that any investments you make out of your traditional IRA can also be made out of any other IRA. There aren't account-specific investments. This is some differences between the 401k and the IRA. We only deal with solo 401ks and self-directed IRAs, obviously, because we're a self-directed custodian. But the main differences between these accounts are usually the 401ks have higher contribution limits. You can invest into life insurance with a 401k where you cannot out of an IRA. For solo 401k in specific, you do need to be self-employed. And the 401ks are the only employer plan that you can actually, or only retirement plan that you can actually take personal loans against. And it has to be either $50,000 or 50% of the account balance, whichever those two amounts is less. And then at the very bottom, you'll see that UDFI rules do not apply to 401ks where they may apply to your IRA. UDFI stands for unrelated debt finance income. That's a tax we'll talk about towards the end of the presentation with the tax consideration slide. Again, not a tax professional here, but you will want to talk about that, or you may want to talk about that with your tax professional. Here we have a slide showing $100,000 of earnings through four different avenues of investment. What do you get to keep? So let's say you earn $100,000 with your salary or your W-2 job. With this specific example, you're in about a 40% tax bracket. You're paying federal taxes, you're paying state taxes, you're paying local taxes, you're paying Social Security, Medicare. Your employer is also paying taxes. And this will vary depending on your locality, whether you're in a big city or if you're in the suburbs or wherever you may reside, it'll vary. But in this specific example, you're paying about $40,000 in taxes or 40% and only walking away with about $60,000. Right below that, you have your passive income through your where you earn rent, interest, and dividend payments, things like that. You're not paying that Social Security, Medicare taxes. You don't have an employer to pay those taxes because these are your personal ventures. So rather than paying 40%, you're paying 25% in this example, and that $100,000 only turns to $75,000 that you get to keep, where $25,000 is going to Uncle Sam to help him keep the lights on. Then right below that, where we're going to be talking through the duration of this presentation, are the tax deferred and the tax free accounts. Both accounts, that $100,000 earnings goes back. $100,000 of earnings goes back into the account. $100,000. However, there's an asterisk next to the $100,000 for the tax deferred IRAs or retirement accounts, because when you take it out of the account, you're going to pay taxes on that $100,000 based off your current tax bracket. However, in the tax-free account, you already paid your taxes. So when you take it out for a qualified distribution, that's $100,000 you get to keep. This slide we're looking at right now is just basically a continuation of the previous slide, to show you investing $50,000 through different avenues of investment. You have your blue taxable income, you have your green tax deferred income or investments, and then your dark green tax-free investments. All of this is $50,000 initial investment over 40 years at a 10% rate of return in a 30% tax bracket. Compound interest isn't as strong with the taxable income because you're paying taxes all the way throughout. It's a little bit stronger. It's exactly as strong in the traditional and Roth IRAs, because where you only earn $700,000 at the end of the 40 years with your taxable income, it's important to note that both tax deferred and tax free accounts both earn $2.2 million over those 40 years. However, when you took it out of the account, out of that tax deferred account, you paid your taxes at a 30% tax bracket, you ended up paying about $700,000 worth of taxes, where you didn't have to do that in the Roth IRA. And if you decide to take it out, it's $2.2 million that you get to keep. So these are the main differences. if you take anything from this entire presentation, take this with you because it shows you the strength of using your retirement accounts to deal with these investments that you may be using outside of your retirement account as well to make such good earnings. So every day I speak to somebody and they want to talk to me about an investment they want to make. These are the different types of investments that you can make out of your self-directed IRA. You're not limited to these. That's why we have other listed here. But the main things we see our clients invest into every day is real estate. And when I say real estate, it's not just lending on real estate. It's not just investing into a company that deals with the real estate. In this example, we're talking about actually purchasing a property with your IRA, where your IRA is the owner of that property, whether it be we'll talk about it a little bit more in the following slides in a little bit more depth. Below that, you have private lending like notes and mortgages. You have private placements, precious metals and commodities like precious metals. And then, like I said, you have other. You're not limited to the top four categories. We have people who invest into cryptocurrencies. We have people who invest into livestock, farmland. We have people invest into. I've seen people buy bees and sell the honey. I've seen people invest into fruit trees that sold the fruit. The options are vast if you actually are creative with it and you follow the IRS guidelines. So in depth, a little bit more in depth about each of these categories. I won't go in a lot of depth, but more in depth just in general. When we talk about real estate, like I said, we actually consider real estate in this example purchasing the property, and not one of the other arms of real estate that you can look at. We're talking about you can own residential, you can earn commercial. It could be single family, it could be multifamily. It could be undeveloped plots of land. It could be leveraged property, and you can actually purchase property outside of the U.S. There are some rules with that, and we can go over that if you want to talk about it offline. But real estate, you can purchase a property with your IRA or retirement account with an account at a self-directed custodian like Camaplan. We'll talk about how that process looks in a few slides, and it'll apply to pretty much all of these investments. Next very common investment we see at Camaplan is private lending. So you can actually turn your IRA into a mini bank. What the banks are charging people, you can charge people within your IRA. So these can be secured or unsecured. I'd rather have my investment secured. And if you do that, it can be in the form of a mortgage, that security. These are promissory notes. You can also invest into convertible notes, meaning terms in the note dictate that the loan turns into shares of equity at a certain trigger point. And then you can also purchase discounted notes. You don't have to originate the note out of the IRA. Your IRA can actually purchase notes on the secondary market as well. Next up, we have probably the most common investment I've seen at Camaplan. This is investing into privately traded companies through a vehicle called a private placement. So before companies go public, a lot of people didn't know that you can invest into them with your retirement funds. You thought you could only deal with publicly traded assets like on the stock market, but you can actually invest into them through that vehicle called a private placement. They'll have a private placement memorandum and a subscription agreement, but these are companies that have not gone public yet, and your IRA can actually purchase shares of them just like they can purchase publicly traded shares. Again, probably the most common asset we see at Camaplan, probably because it tends to be more passive, but another option to look at if you're looking to make investments out of self-directed IRA and diversify your retirement portfolio a little bit more. Right after that, recently a pretty big investment at Camaplan is precious metals. So the IRS says that you can actually purchase gold, silver, palladium, platinum, bullion, and some coins through your IRA. And there's also another option, which is precious metals composite. It's a combination of those previous four metals. There are restrictions for this, and we're going to go over that when we talk about what you can invest into with your IRA. We'll go over that next. So we just went over what you can invest into. We're going to talk about the few things you can invest into with your IRA or retirement account. So the IRS wants to prohibit any collectibles and life insurance being purchased out of the IRA. They don't want you going to a garage sale and purchasing with your IRA a $20 painting you see at the garage sale, and it turns out to be like a $2 million painting. So they want to avoid things like that. So any collectibles, works of art, stamps, alcoholic beverages like wine or anything like that are prohibited to be purchased out of the IRA. However, you can invest into companies through those private placements that may be dealing with these niche areas, as long as the IRA isn't being a direct owner of any of these collectibles, so to say. And then at the bottom, like I mentioned with the last slide when we were talking about precious metals, there is that exception made by the IRS for U.S. government minted metals that meet certain standards, quality, purity standards, and they vary depending on the actual metals themselves. Precious metals dealers that you're working with are already probably aware of these requirements, and if not, we can have a conversation with them if you'd like. But you can purchase precious metals through your IRA. More things that are prohibited within the IRA or retirement accounts by the IRS, and this isn't just self-directed. All these rules, I should say, these aren't just self-directed IRA rules. These are IRA rules in general. Again, self-directed is just an adjective. All the rules that apply to any other IRA that you're dealing with apply to the IRAs here. Self-directed is just an adjective. The accounts themselves are no different. What the IRS prohibits to be invested, some transactions that are prohibited by the IRS are personal use, self dealing. So the IRS basically says that the retirement account you set up is strictly for the purpose of growing your retirement account and using it as a part of your retirement portfolio and your retirement plan. They don't want you receiving any personal benefit from it or providing any personal benefit to the IRA and its investments. So let's use the example of real estate. If your IRA were to purchase a property, you yourself wouldn't be able to go in there as the account holder and do any work on the property. You couldn't paint the walls, you couldn't do the plumbing. Your IRA would actually have to pay somebody to do that work on that property. And then on the other hand, that's where we're talking about self dealing. You also can't purchase or sell to yourself with your IRA. Purchase from or sell to yourself with your IRA. And then on the other hand, there's no personal use. So you purchase a vacation home with your IRA. You as the account holder and some prohibited or disqualified persons we'll talk about in the next slide are prohibited from staying in that property even one day out of the year at all. It's for your retirement account. You can't use that property personally. All right. Like I said, some disqualified persons is a good visual here. So in this chart, it's basically anybody of lineal, ascent, or descent of you as the account holder, including yourself, and any entity that these people own 50% or more of or have managing control of. So anybody in the dark green in this slide is prohibited. Anybody of lateral relation to you, like in the light green, like aunts, uncles, cousins, siblings, nieces, and nephews, they're okay. But you can't invest into or receive a direct benefit from these entities. There are some other ones like fiduciaries of the plan you can view on our website, but the people in dark green are prohibited from receiving any direct benefit from the IRA and its investments, nor can they provide a direct benefit to the IRA and its investments in those examples in those examples I mentioned in the last slide. However, a good note to make is you can actually partner with these people even if they fall into this qualified persons category, as long as you follow the IRS guidelines, and we could go into that offline with a call. We also have a nice article on our website called 20 Ways to Fund a Deal, where it talks specifically about partnering with different entities, including some of these people and their IRAs as well. But it's a good tool to have in your tool belt when you're approaching self-direction. Now, how does the process look? So it seems like a lot of steps, but a lot of these are behind the scenes of us processing paperwork at a very high level. You open up the account at Camaplan, you fund the account from an existing account elsewhere or from a contribution just like any other IRA. You pick out your investment, you identify the property you want to make, the borrower you want to lend to, the company you want to purchase shares of. You submit the documents to Camaplan, the supporting documents for the investment and our direction of investment form. We process that within 2 business days and send the funds to the investment provider based off on the instructions you provided. All we're looking at in the paperwork is just to make sure it's titled properly, where the IRA is the owner of that investment or the lender on that investment. And the IRA is important to note, it's a separate entity from yourself, similar to a trust. So it's not you going out and making these investments. It's your IRA. Again, separate entity from you. You can even get an EIN number for the IRA as well. I tell people to expect from the date they open the account to the date they make their first investment is about 3 weeks on average. The biggest chunk of that time is it tends to be the funding section because we process everything on within 2 business days of receiving paperwork in good order on our end. However, it may take the other custodian or plan administrator about 2 weeks on average to send those funds over. But don't worry about that. We'll walk you through it. We'll hold your hand. We'll tell you what to expect throughout the process. But on average, it takes about 3 weeks after the account's been funded and you're working on capital already within the IRA CAMA plan. Transactions are done very quickly. So why do you need CAMA plan? That's a lot of good information. So where do we come in? So the IRS actually requires that you have a third party look after your retirement accounts, like us. That's where we fall in. We're a neutral third party. We don't tell you what to invest in. We don't sell any investments. We're not attorneys, tax professionals, or accountants, so we're not going to give you any advice. And we're not looking through your investment paperwork to tell you if it's a good deal. Like I said in the last slide, we're only looking to make sure that the investment is titled correctly and that you've signed or if you've initialed that document showing us that you've read and approved of it and are giving us your permission to send the funds on behalf of the IRA to make this investment. We keep record of all those transactions for you within the IRA, and then we report to the IRS at the end of every year, just like any other custodian of IRAs. But at the very bottom, you'll see it's italicized. We are a part of your core team of professionals. So do your due diligence, bring in your professionals, have them ask us questions, bring in your investment providers, get them comfortable with the situation, the process, and make sure we're all on the same page. We're happy to be a part of any conference call or email thread, or if you even want to come into our office, you're local, you want to bring them in, we're happy to talk to them and make sure everybody's, again, on the same page and is comfortable with the transactions that are about to happen. These are some frequently asked questions. We touched on pretty much all of this. If you want more information about these questions, this will be recorded, but you can also call our office and we can go over the specific investment you're trying to make, go over the process, hold your hand, tell you what to expect. But we're not going to really spend too much time on this. Lastly, we'll spend a very short amount of time on tax considerations and resources because, again, I'm not a tax professional. These are just some things that we're aware of within the IRA that you may want to run by your tax professional if you think some of these things may apply to you because they're going to be the final say on what you do. So in, I think, the third slide, we were talking about differences and we did bring up UDFI. Usually IRAs don't pay taxes, but in some instances they do. Those two examples are UBTI and UDFI. So UBTI stands for Unrelated Business Taxable Income. This is, again, at a very high level, is basically when the IRS deems that your IRA is doing transactions outside of what the retirement account was set up to initially do. What that means is basically the IRS says you're running a business out of your IRA. So the biggest things that I see that might come across this example is if you're flipping properties out of the IRA. Now, what the IRS's definition of the flip is, they'll never say. Some people say if you do this many a year, you're okay. Some people say if you hold each property for a year, you're okay. Those people aren't the IRS, and the IRS, again, most likely will never say. But if you're flipping and the IRS considers it's flipping by its own definition, it'll look at the properties that you're flipping as inventory in and inventory out, and they may say, hey, you may have to pay this tax. Another thing that I've seen trigger UBTI personally is developing on undeveloped land. So if your IRA goes out and it purchases a plot of land, it has nothing on it, instead of just using it as a buy and hold and seeing and just using it as a buy and hold, and you decide, hey, I want to build a property on this plot of land, and your IRA hires a developer to build on that land, the IRS says, hey, you may be running a development company with your IRA, and you may be due those taxes. There are some more specifics with that to bring up with your tax professional or your accountant. And then the other option, or the other tax that sometimes is paid out of the IRA, or the IRA may come across, is UDFI, which stands for Unrelated Debt Finance Income Tax. So when you're purchasing a property out of an IRA, you can receive financing for that property that you're looking to purchase. However, it has to be through what's called a non-recourse loan. We can go over that in more specifics. However, if you do receive that type of, the non-recourse loan, I should also say, is not like your traditional financing, and we can go over specifics offline if you'd like. If you do receive that financing for property you're purchasing within the IRA, the IRS will probably hit you with the UDFI tax, unrelated debt finance income tax. The important thing to note with these taxes is the people that end up paying these taxes when they're doing the transactions out of the IRA are 9 times out of 10 extremely okay with it because they're using their retirement account to grow quicker than they are with the investments they were making prior to doing these investments. And they would have to be paying the taxes anyway outside of the account. So it really depends on how you look at it. But if you do have to pay this tax, bring it up to your tax professional, or if you think you may have to pay this tax, bring it up with your tax professional. If they say, hey, you do have to pay it, they'll file a Form 990T for the IRA, send that in to us, and we would send the funds from the IRA to the IRS to pay for those taxes. Again, bring it up with your tax professional. Not a huge deal for a lot of people, but it's a good thing to know. And when you're talking to specific investment providers as well, they probably will be impressed if you have this knowledge already and you bring it up to them. Here we have a list of basically where we pulled all of this information from to make sure to let you know we didn't make any of it up. So we have the specific IRS regulations, different court cases, publications, the Form 990T we just went over, court cases, private letter rulings that we also have on our website. If you want to just want to prove that we're not making this up or pulling it out of thin air. If you have trouble sleeping at night, you can print these out and keep them by your bedside. It might be useful. But again, this is where all the information was pulled from. Here, lastly, we have my contact information. If you or anyone who you know can benefit from the information that we could discuss about self-direction, have any questions, please give me a call, shoot me an email, call our office. We're happy to help and go through any specific scenarios you would like to go through. Bring in your professionals, like I said 3 times already. We'd love to talk to them as well. But please do not hesitate to contact me or our office. I'm always happy to help. And now is a good time for questions. If you have any questions, just let us know. I'll give it a few seconds. Usually people are still reeling from the information, want to digest it a little bit more and end up giving us a call later or shooting us an email. So I'll give it about 30 seconds. If we don't have any questions by the end of this little spiel, then we'll go ahead and wrap it up. We do these every week, Tuesday in our office at noon Eastern time. We do them live in person, and we also do them online. So if you want to come into our office, you're in the area of Ambler, Pennsylvania, you want to see the location, you want to talk to us in person, meet the team, bring in your family, bring in your friends, bring in your professionals. We can do the presentation specifically for you and your group, and answer any questions face to face if you'd like to do that as well. It looks like we don't have any questions today, but if you have any questions, I'll say it again. Feel free to reach out to us at any time. I want to thank anybody who attended this presentation online and anybody who might stop by in the future. I hope you all have a great rest of your day.